What happens when a president tries to fire the most powerful man in finance? Spoiler alert, it's not good for your portfolio. In this one, we're diving a little deeper into some Trump v. Powell drama and what it could mean for the markets, the dollar, and your investments. Coming up. Welcome back. My name is Stephen Spicer, and over the last 15 years, I've helped clients break down this financial noise so that they don't get wrecked by it. And today we're breaking down the intensifying battle between President Donald Trump and Fed Chair Jerome Powell. A battle that's no longer just political theater. It's becoming a direct risk to the stability of the financial system. Now, let's rewind the tape for a second. In February 2018, Trump nominated Powell to lead the Federal Reserve, believing he'd be a continuation of Janet Yellen's accommodative policies. Instead, Powell quickly shifted course, raising interest rates 4 times that year, aiming to normalize monetary policy after years of post-crisis stimulus. Trump was not pleased. He began lobbying Twitter-based attacks on Powell, blaming him for slowing down the economy and calling rate hikes loco. He blamed him for all your financial concerns. By December of that year, Trump reportedly asked White House lawyers if he could legally fire Powell. For the record, it's unclear whether a president has that power or not. Anyway, that was just the beginning. Fast forward to 2025. Trump's criticism has hit a whole new level. Trump has described Powell as a disaster, said he wasn't my choice, kind of was, and openly blamed him for inflation, falling markets, and what he calls the Biden economy. He's made it pretty clear he wants Powell gone. Here's the kicker. Powell's term doesn't end for more than another year. So unless Powell resigns or is somehow removed with cause, neither of which is likely, we could be headed for an unprecedented showdown between the Oval Office and the Fed. And why does this matter? For one, because the independence of the Federal Reserve is not just some academic concern. It's foundational to the credibility of the US dollar, the $29 trillion treasury market, and frankly, at this point, the entire global financial system. And the markets are paying attention. When Trump unveiled his April 2nd Liberation Day tariffs, an aggressive move to restructure trade with China and Mexico, the S&P 500 had its worst 2-day slide since 2020. Over $2 trillion in market cap vanished. Bond yields spiked. The dollar slumped. And then the reversal. Just a week later, after intense backlash from business leaders and a collapsing stock market, Trump suspended most of the tariffs, calling it a temporary reassessment. He walked it all back, or at least put most of it on pause. And just like that, the S&P 500 surged 9.5% in a single day, recovering nearly all of its losses. So why the whiplash? Because the market is acting as a moderating force. Policy overreaches trigger volatility, and they're doing so ever faster and at a more violent pace, which then pressures the politicians to back off. We've seen this play out before. Remember December 2018? After weeks of Trump badgering the Fed and a brutal stock market sell-off, Powell signaled a pause in hikes. Whether that was coincidence or not, we'll never really know. But markets saw that as validation. This time, though, the stakes are higher. Inflation is sticky. The Fed has set rates above 5%, and Powell has been clear the Fed won't be bullied. He's said, quote, "We will not take political considerations into account." That kind of independence is crucial because monetary policy should not follow the political cycle. Historically, when central banks lose independence, ultimately inflation tends to spiral, growth collapses, and currencies can lose credibility. Look at Turkey under Erdogan. When he forced central bankers to cut rates despite high inflation, the Turkish lira lost over 80% of its value in just 5 years. Look at Argentina, where government pressure on the central bank to finance spending led to annual inflation rates topping 100% in 2023. Look at Venezuela, Zimbabwe, the Weimar Republic, the list goes on. Political pressure to print, to cut rates, to juice short-term growth. It leads to long-term pain. Hyperinflation, crushed savings, investor flight. Now, the US is not Turkey or any of those other countries, but it requires willful ignorance to actually think that means we're immune. In the United States, Fed independence has helped keep inflation relatively stable for decades, anchored long-term treasury yields, and made the dollar the world's reserve currency. But that trust isn't bulletproof. It's already starting to waver. Remember, the US Treasury market is nearly $29 trillion. It underpins the entire global financial system. Roughly $7 trillion of that debt is held by foreign investors. If they start to believe that US monetary policy is no longer independent, they'll demand higher yields to hold our debt. That means higher interest costs for the US government and more pressure on taxpayers. Already, major bond investors like PIMCO and BlackRock have warned that US borrowing costs could rise if Fed credibility erodes. In recent weeks, 30-year mortgage rates spiked back above 7%, even though inflation reports were moderating, because investors are pricing in political risk. Since mid-2023, inflation progress has stalled. Core PCE, the Fed's preferred gauge, has hovered near 3%, well above their arbitrary 2% target. Meanwhile, wage growth is sticky, energy prices are up, and geopolitical tensions are flaring. In that context, Powell's job is to tighten if needed. Trump's campaign, on the other hand, is pushing stimulus, protectionism, and more political intervention. That divergence matters. It creates uncertainty for investors, and uncertainty means volatility. Interestingly, markets themselves are acting as a moderating force. Trump's aggressive policies, like the tariffs, sparked massive sell-offs, forcing him to backpedal. We're seeing a live feedback loop. Policy announcement, market crash, political recalibration, temporary calm, and then we continue. But this is an extremely fragile system. Every escalation, every new tariff, every attack on the Fed erodes confidence a little more. Right now, markets are still assuming that cooler heads will prevail, that institutions will hold. But that assumption is being tested more aggressively than at any time since the Nixon era, when political pressure on Arthur Burns helped ignite the inflation of the 1970s. So what should you do? Ideally, you position yourself, your portfolio, so that it's prepared no matter what chaos comes our way. Because although I don't know exactly what the future holds, if I do know one thing, it's that it will hold some form of chaos. So yeah, it's worth being prepared. That's why we put together our financial doomsday survival guide. Once you make it through all that, you won't need to stress near as much about these things. But while you're working your way through that, here are 4 things you can do right now. First, don't bet on political headlines. They create noise, but often reverse quickly, as we saw with the tariffs. Second, prioritize quality. In times of political and market turmoil, assets with strong fundamentals, think cash flowing businesses, investment grade bonds, essential infrastructure, those tend to outperform speculative plays. Third, watch the yield curve. If Trump pressures the Fed and the market senses inflation risk, the long end of the curve will rise. If you're doing all this on your own, that's your signal to reevaluate duration risk and inflation hedges. And fourth, remember that we've been here before. Nixon pressured Arthur Burns. Reagan did the same thing to Volcker. Trump's not inventing this playbook, but the intensity has increased as of late, and the economic backdrop does seem more fragile. But still, this isn't entirely new. It's a smart move politically, too, on Trump's part. If things go well, he can take credit. If things go poorly, he's already perfectly teed up a scapegoat. Big picture, though. This fight between President Trump and Powell isn't just political drama. It's a battle over the independence of our most powerful economic institution. The outcome could impact interest rates, inflation, and market confidence for years, decades to come. We've already started to see faltering confidence in the US dollar from some of the world's smartest money. I explain all of that and what you can do about it in this one. I'll see you there.